When the tech frenzy of the late 1990s crumbled, it was like a tidal wave washing away $5.9 trillion in family savings. Then came the real estate collapse of the mid-2000s, a storm that eroded over $9 trillion more. The wreckage these economic whirlwinds leave behind is staggering. Lives upended, dreams shattered. So why do these tempests keep brewing? Why do we seem doomed to sail into them again and again? Are we just too stubborn to chart a safer course? The easy answer is that humans are wired to chase treasure, and that hunger is etched into our bones. That's a fair enough take for most. It's simple. It nods to our flaws. But hold on a second. As we explored earlier, nobody's truly unhinged. People make money moves they later regret, often fumbling in the dark with patchy info and shaky reasoning. Yet in the moment, those choices felt right to them. Pinning it all on greed and calling it a day skips over the deeper currents. How folks convince themselves that what looks reckless now made perfect sense then. These economic swells aren't like a broken engine where a mechanic can pop the hood and pinpoint the glitch. They're more like a wildfire, spreading fast, fed by a tangle of sparks, and only clear once the ashes settle. Everyone's got a theory about who struck the match, but good luck getting consensus. The race for profit is a brutal sport, and every prize, every stock, every property, has to have a taker at any given moment. That's why the very notion of bubbles stirs up a fight. No one wants to admit they're clutching a hot coal. After the flames die down, we're quicker to sneer than to study. I doubt we'll ever fully unravel why these surges happen. It's like asking why rivers flood, too many tributaries, too much mud in the water, and everyone's got their own story about the rain. Simple explanations drown in the complexity. But here's one angle that often slips under the radar, and it hits close to home. People innocently follow signals from others who are chasing a totally different horizon. There's a sneaky little myth in the money game that's caused untold chaos. The idea that every asset has one true price, even though everyone's rowing toward different shores. Picture this. How much is a share of Horizon Tech worth right now? Depends on who's holding the oar. Got a 25-year voyage ahead? Then the smart price hinges on a calm look at Horizon's future cash tides over decades. Planning to jump ship in 5 years? You'll weigh the tech seas ahead and whether Horizon's crew can steer straight? Looking to bail by next summer? Focus on today's wins, product buzz and market gusts. Day trader? Price is just noise. You're riding the choppy waves for a quick buck before dusk. When folks are navigating with different maps and timelines, and they always are, a price that seems bonkers to one can feel like smooth sailing to another. Their compasses point to different stars. Rewind to the tech boom of the 90s. People gawk at Skynet stock back then and scoff. Ludicrous? A gazillion times earnings? Insanity. But for the rapid-fire traders holding it, the sky-high price fit their sprint. They didn't care if Skynet was $10 or $1,000 a share. They just needed it to twitch upward by sundown. And for a while, it did. Money loves a tailwind, and when something's climbing, it's not wild for short-haul sailors to bet it'll keep rising. Not forever. Just long enough. That's not madness. It's momentum. Here's where the storm picks up speed. When those short-term gusts draw enough treasure hunters, the crowd shifts. Long-haul voyagers get outnumbered by sprinters. Soon the ones setting the pace and the price are those with the shortest fuses. The swell isn't really about prices ballooning, that's just the wake. The real shift is the shrinking horizon as more sprinters flood the deck. We often call the tech boom a fever dream of endless tomorrow. But check the logs. Trading volumes hit record highs, with shares swapping hands like hot potatoes. The average investment fund flipped its haul 130% a year, barely a 7-month tether. The chatter was all day trades, quick options, and minute-by-minute updates. That's not the rhythm of a distant shore. Same deal with the housing surge of the 2000s. Dropping $650,000 on a modest Texas bungalow seems unhinged if you're settling in for a decade. But if you're flipping it in 6 weeks for a profit, that's a different tide. Data from BrickPulse shows homes flipping, sold twice in a year, jumped from 18,000 in early 2000 to 95,000 by 2005's peak. Post-crash, it sank back to 35,000 and stayed there. Did those flippers fuss over long-term rent yields or income trends? Nope. All that mattered was next month's price bump, and for years, they got it. You can label these folks gamblers or daredevils. You can roll your eyes at their tightrope act. But irrational? Not entirely. Bubbles aren't about wild faith in forever. They're about chasing a fleeting breeze that's already blowing. The trouble starts when the steady mariners, those plotting a long course, start steering by the sprinter's wake. Take Zenith. Stock in '99. It soared 250% to $55, valuing the company at $550 billion. Absurd, right? Analysts chuckled that it'd outgrow the whole economy in 15 years. The sprinters didn't care. They'd be gone by dinner. But if you were in it for the long haul, $55 was the only ticket on the table. You might have thought, maybe they're onto something. You bought in, feeling clever. Problem is, you didn't see the sprinters were racing a different regatta. For them, $55 was fine. They'd ditch it by dusk. For you, holding it for years, it was a shipwreck waiting to happen. These crews don't even clock each other's existence, but they're on the same sea, crashing blind. When they collide, someone sinks. We often navigate by watching others, mimicking or betting against them. But if you don't know their heading, how can you guess their next turn? A pundit on TV yells, "Buy this stock." But who are you? A kid splashing in the shallows? A retiree guarding your nest egg? A fun boss juggling quarterly stats? One price can't fit all three. It's a wild thought. Rational people see the world through different scopes. A rising tide lifts all boats, and egos, luring even the cautious into chasing shadows cast by someone else's game. It can even skew how you spend. Ever notice how much of our splurging is a quiet nod to the crowd we admire or want to impress? A startup founder might need a sleek car to seal the deal. I'm just a scribbler who can roll up in flip-flops. But if I let her ride set my bar, I'm drifting toward a reef. Here's the lifeline. Know your own compass. Few things matter more than plotting your own course and ignoring the chop kicked up by others on a different tack. Yet, how many of us actually do that? We lump everyone with cash into one bucket. Investors. Like they're all playing the same match. Once you see that's a mirage, you realize how crucial it is to name your game. Mine? I'm a patient wanderer, betting on the world's slow grind upward, trusting decades of growth will fill my sails. It's basic, but it keeps me steady. Short-term squalls, recessions on the horizon, not my waters, I don't even glance. Next, let's dive into the undertow of doubt.